Now on stage, Managing Credit Risk in a Trump 2.0 World. Our speaker, Josef Pospisil, Managing Director and Deputy Head of EMEA Corporates at Fitch Ratings. Please welcome him to the stage.
Hello again. So I'll jump straight into it. I think we are running slightly behind schedule, but I'll stick to the 15 minutes I was given, and we'll give you a brief update on Fitch's views on the sovereign or macro picture and our updated corporate views in the EMEA region. Right, do I have? Yes, I have the time there, so 15 minutes there is ticking down. Okay, so my first few slides are on the macro. These are actually borrowed from our macro team. We, as an institution, update and publish our macro views every quarter. So the last publication was from June. We're going to update it later this month. I think in about a couple of weeks, we're going to publish an update. Obviously, the June update was following what happened in April, and the last update before June was actually March. So there was a lot of changes this year in our macro expectations. What you see on the left are our GDP growth expectations for the key economies around the world, and on the right-hand side you see the relative difference in the growth forecast for 25 and 26. Relative to the April update. So we've done the March update as scheduled, then the Liberation Day came and our team thought, okay, this is such a big change, we have to revise it. So there was a sort of bespoke update of our macro view in April, which is why here I'm comparing June to April as opposed to June to March. So there were quite a few revisions to the upside. Clearly, the big shock are the tariffs, okay? And you see a few circles on the right-hand side, Canada, but also US, Mexico especially, but also Eurozone. You see positive revisions to our growth expectations compared to before, which is interesting, but again, one has to acknowledge that actually the April revision was a significant downward revision. So this upward revision in June isn't actually as large as was the downward revision in April. So like for like, compared to pre-Liberation Day, our macro picture is still quite a bit weaker. Now, if I just look at the key trends, you can see that in all these bars are actually trending downwards a little bit from 24 to 25, 26, except for Europe. So Eurozone is actually the lowest in terms of growth, but actually there the trend is stable and then actually ticking up a little bit in 2026. So that's the key message on the macro picture. I think over the summer, what I understand is that the numbers were a little bit better than expected from Europe, and otherwise relatively as expected. So the next update later this month may see some gentle revisions to the upside, possibly. The big theme is the uncertainty this year, okay? And there's just two charts really showing you how significant this is. So, you know, I was asked earlier today about our expectations for the markets for this year. You know, it's anyone's guess, but one has to acknowledge that there is a lot of uncertainty in the markets, and consumer confidence, which drives obviously a lot of industries, a lot of corporates that we rate as well, is actually pointing down. Now this is US, but there's a similar picture elsewhere. The next slide I have is very quickly looking at Germany. The story of Germany is not great, let's say, in terms of the last few years, in terms of GDP growth. The key message is that there is a big hit from the tariffs. So on the right-hand side, you have the GDP impact from the tariffs, which is the negative red bars pointing down. Against that is the infrastructure and defense spending, which the new German government announced earlier this year. And you can see this is going to be an offsetting positive impact. You can see that this year is kind of almost balanced. Next year, we think that the tariffs will actually still be pulling down the growth. But then from 27, the story will actually reverse. And we should see the net impact of the two actually pulling up the growth, which, again, going back to the Eurozone, there is a gentle improvement expected for next year. So a little bit of a positive, let's say, for Europe. Now, talking about interest rates. So on the left, you have just some inflation components in the US, and on the right-hand side, you have our expectations, again, from our macro team in terms of where the rates are going. So as of June, we were still expecting one more cut in Europe for the end of this year, and then about 2 more cuts by Fed this year, and then three cuts next year. Again, the news flow over the summer has been slightly more positive in Europe. I think we were expecting potentially negative numbers, and they came sort of neutral. So this may also be revised somewhat, but as of now, we still expect basically interest rates going down. Now, what does it mean for corporates? So we were just listening to some of the panels here about the spreads. This is a very long curve for credit spreads in Europe in high yield, but also investment grade BBB. You can see there is the green one. Lots of crises here. And the last one, a lot of volatility, and the spikes at the end are obviously the Liberation Day. All the markets were basically selling off. But as you can see, it actually didn't last very long. And right now, the spreads are actually tightening. And even in the triple Cs, they were actually significantly inside where they started the year. So the markets have improved quite quickly. Again, this is just the nature of markets. They are good and bad day by day. New issuance has been affected only mildly so far. So the red bars or the red lines are cumulative LTM issuance on the left, investment grade on the right, high yield. You can see that there was a little bit of decline lately for high yield in Europe, but essentially it's not like the primary markets are closed. They are actually quite robust. Now, what does it mean for corporates and corporate ratings? Now, so when, again, the Liberation Day came, we had to stop and think for a bit in terms of what do we actually do, which ratings may be affected. This is a quick comparison of, let's say, the current uncertainty or crisis, we can say, or shock, compared to some of the earlier ones, like the great financial crisis, Eurozone crisis, and so on. You can see that quite a few of the key variables are actually not as bad, let's say, as they were in some of the prior shocks. So from that point of view, it doesn't seem to be as bad. But there are clear implications from the tariffs on corporates. Okay, they are direct and indirect as well. So the direct is obviously especially for the exporters, and indirect pretty much for everyone because growth is slower than it would have been otherwise. Okay, so these are some of the key points that we were considering, thinking about the risks top-down for the different industries. And it's been really an exercise that's the nature of the work that we do. Corporates are hit by shocks every few years. You saw the table there, and we have done this exercise before. We basically sit down, think about the scenarios, obviously listen to our macro team in terms of what is the key assumptions for the macro, for the growth, for interest rates, and so on, and then think about the individual sectors and how can they be affected. So this is drilling down just EMEA, but we published a similar sort of traffic light table for global corporates. So the columns were the different regions, and you see different sectors, and we identify which sectors are hit directly and through what sort of channel, And then indirect impact, again, is chiefly the slower economic growth, and you can see the red flags there, and it's clearly focused on chemicals, automotive, but also some technology, and alcohol exporters to Europe were also targeted by some of the policies. So these are the red flags we've identified. And again, this is something we published as early as May, I believe. So this is, again, the nature of the work that we do, trying to share our thoughts on the shocks as they come. We publish not only individual corporate ratings and corporate rating outlooks, we also have a sector view. And this is, again, thinking about, okay, how is this sector actually doing compared to a year earlier? And we update our sector outlooks at the end of each year. So typically November, December, we publish a report for each of the sectors. And it's not only corporates, by the way, it's across the rated universe, so structured finance, banks, sovereigns, and so on. And so you see the sector outlooks on the right as they were in December. Again, thinking about an update in June, we saw that obviously the shock has brought some clouds to many of the areas, and we've changed the sector outlook across the board for quite a few, and you have them listed here. I'm not going to go into the detail because the time is ticking. Then, when we established the sector view, we obviously looked at the individual ratings. So we have a rating case forecast for each of the ratings that we do, and effectively this spring we have reforecasted, or at least acknowledged, the new assumptions for each of those. And this is the cumulative impact of the revisions, not only in March this year, but also sort of at the end of last year, because that came already after the election, or it was quite clear that the shock that may come is going to be quite severe. And so the cumulative impact on revenue assumptions across the different industries is here. So you can see on the left the industries that this time last year we were expecting quite a lot more revenues compared to now, and some were actually less impacted, but it's mostly natural resources, which are obviously driven by the prices of the commodities. Now, so the revenues are down overall compared to before, but actually there is still quite a lot of growth, at least in the... so this is, again, just what we rate. This is not the kind of top-down macro view for the industries. This is an aggregation of the individual bottom-up forecasts for the companies that we rate. In EMEA, we rate something like 700-800 corporates, so this is the aggregate of them across the different sectors. And you can see that despite the downward revision of revenues, there's quite a few industries that actually will still see a revenue growth. And again, this is an individual forecast, so obviously these companies don't operate only in the areas that are most affected in terms of the geographies, but many of them are actually global and diversified, which obviously helps them quite a lot. The next one quickly is the EBITDA margin, which obviously like for like has come down, but again we actually do expect, and this is looking at 24, 5, and 6, so there is still quite a lot of positive improvement in the margin overall, because obviously companies do not stand still. They react, they adapt to the new environment and see how they can actually mitigate. In terms of the actual rating impact, every rating has a rating sensitivity where we basically give a guidance on, okay, so rating is X, what can take it up and down? Quite often, what can take it up and down is higher leverage or lower leverage. This is giving you an idea of how many, so this is a share of the ratings in individual sectors, so how many of those ratings exceed the rating sensitivity for a given rating level. And you can see that again in chemicals or technology, there was quite a high share of companies that had leverage, which was already quite high for the rating. Now, we don't downgrade immediately when we see a leverage spiking. We obviously rate through the cycle, which may be industry cycle, investment cycle, that drives leverage temporarily higher, but it is a warning signal. So again, there is some commonality in the industries that I've highlighted before in terms of the revised outlook. Then I move to actual rating outlook. So every rating has its own outlook, and the cumulative number of these outlooks is portrayed here, and the yellow curve is basically the net difference between the positive and negative. On the left-hand side, you can see in investment grade, lately, and especially post-COVID, it's very much improving curve. There is a lot more positivity for outlook. So in investment grade, generally you see a few more positive outlooks than negative. In the high yield, the story is actually a little bit different. Well, it's opposite, it's still net negative, meaning that obviously these companies have much more financial risk on their balance sheet, and therefore the uncertainty is creating more pressure on them, and overall we see a few more negative outlooks in that space. So I briefly talked about the current worries. So this is a sort of a snapshot of things we kind of think about in terms of what do we need to worry about. Our job is to worry, right? We are credit analysts. We look at the downside. So I've basically touched on the tariffs and the policy uncertainty on the left, which is the current worry and quite high in terms of the effect. The reason I'm kind of having it here very briefly, my time is pretty much out, is the climate risk. And to give you a little bit of a sort of marketing slide, we have now incorporated the climate vulnerability risk directly into the rating, directly into our rating methodology. And when we publish a rating and a rating report, the reader can not only read the current rating and the current rating outlook, they can also see how is the industry and the specific company within the industry, in our view, exposed to policy changes which may affect its business risk in the long term. So this is looking at a very long-term curve, and depending on the industry these companies are in, we basically signal that vulnerability. Now, I'm not going to spend too much time on the framework, but it is out there, it's publicly available, it's part of the service that we do. Final slide from me is just, again, the coverage in Greece. So I was sitting here earlier with a couple of the companies that we actually rate. So you can see 6 of them on the corporate side, but quite a lot of banks. Basically, the banking sector is well covered by Fitch. And we are looking forward to share more thoughts in future with you on new ratings as we publish them. With that, my time is out. I'm happy to take questions later on. I'm going to be around for the rest of the day. But I think now it's time for coffee, if I'm not wrong. Thank you.